As a former stockbroker and now investment coach, I've been helping people get started investing for over 25 years. And one of the biggest misconceptions I see holding people back is the belief that shares are too risky, too unpredictable, or a little bit like gambling. Now, sure, there are some risks, but not in the way most people think. So in this video, I'm going to help you understand what the risks of investing in shares really are. We're going to look at what makes the share prices go up and down, and then we're going to look at 5 very simple strategies that you can use to reduce the risk and get started investing with complete confidence. And if after watching this video you would like to learn more about getting started investing, then check out the link in the description below to my beginner's guide to getting started investing cheat sheet. This is a question that I've heard so many times over the years. Isn't investing in the share market risky? And this cartoon here where the lady says, you know the difference between the stock market and the casino? You actually have a chance of winning at the casino. This is a sentiment, this is a belief that I see so many people hold, and it could not be further from the truth when you approach investing in shares the right way. So my big goal for this video is to help you understand what the risks of investing in the share market really are, so that you can understand them. And then I want to share with you, how do we negate most of those risks so that you can invest in shares with confidence? Because there is no doubt that investing in the share market is one of the best ways that you can get your money working for you. So let's start by looking at what investment risk actually is. Now, it's a very simple definition. Investment risk refers to the possibility that an investment's actual return will differ from what is expected. So that's what investment risk is. Now, to help us understand what share market risk really is, we first need to understand, well, what is a share? The formal definition of a share or a stock is they are units of ownership in a company that provide for equal distribution of profits, if there's any profits declared, in the form of a dividend. So in real world speak, that means that when you own a stock or a share, you literally part own the company, and if that company pays profits, then you have a right to receive it in the form of a dividend check. Okay, so that's what a share is. So what I want to do now is take you through a couple of examples of real world companies to help you understand, why does a share price go up or down over the long term. So what we've got here is Apple computers. Now, what we can see down the bottom here is, these are the profits that Apple has made over the last few years. So we can see in 2023, it made $94 billion in profits. 92, it made $95 billion in profits. You can see in 2019, 2018, it made over $100 billion in profits in those years. And what happens when a company makes profits, it can take those profits and use it to grow the business even more. And as it uses those profits to grow the business becomes more valuable, which means that your portion of, so your share of the company also increases in value. And we can see down the bottom here that Apple, if you bought 1,000 Apple shares back in 1980, when Apple first became a company, back in 1980, you could have bought shares for 14 cents. So 1,000 shares would have cost you $140. And you can see today, those 1,000 shares would be worth well over $180,000. And you would have received $45,000 in dividends along the way. So what that means is the value of your shares have gone up, and not only the value of your shares gone up, but along the way, Apple sent you dividend checks as well that valued to $45,000. So not a bad investment at all. But let's now have a look at Rivian. Now, Rivian is an electric car maker. We can see here, now this isn't in billions, it's in millions, Rivian, but in 2016, they made $86 million in profit. 2017, they make $94 million in profit. 2019, they made 101. But then ever since then, the value, the profits of the company have started to go backwards because they started to invest very heavily into electric vehicles. And you can see here that in 2022, they made a $465 million loss. and almost a $3 billion loss in 2023. And as a result, you can see that if the money's being taken out of the company, the value of the company is going down. So we can see that if you'd bought one Rivian share in 2022 for 130, today it'd only be worth $14.88. And the share price, as a result, you can see the share price has gone down. So not such a good investment. So what we can see here is that over the long term, the value of a share will track according to the profitability of the company. If the company makes profits and keeps those profits to grow the business, then the value of the shares in that company will go up. If the company loses profits, in fact it loses money, makes losses, then the value of the company will go down. That is a long-term view. So that is what happens when we invest for the long term. The problem is, in the short term, the picture can be a little less predictable. And here again is our chart of Apple computers. Same chart, but what you'll notice now circled here is a period from the middle of 2021 to the beginning of 2023 where Apple share prices went from about $185 down to $125, which means it lost 30% of its value, despite the fact that it still made $94 and $95 billion in profits. So why did the share price go down? The value of the company actually went up. Well, this is because there is one big problem when it comes to investing in shares, and that is most investors are irrational. And in the short term, emotion, not value, drives price movement. And this is something that is really important to understand, that in the very short term, fear and greed are a very real driver of share price direction. In my old stockbroking firm, one of the partners there used to tell his clients when they rang up in a bit of a panic saying, "Why is the share price going down today?" He would say to them, "Well, it's going down because there's more sellers than buyers." And if the share price was going up, he would say to them, "Well, it's going up because there's more buyers than sellers." And this is very, very true. It was a bit tongue-in-cheek because the reason people were ringing up was to find out, well, what is it that's causing there to be more sellers? Or what is it that's causing there to be more buyers? So if we look at just some of the reasons why people might want to sell shares, things like fears, rumors, maybe they need the cash, maybe there's been some negative company news, maybe there's negative economic news. If we look at what's happening in the world at the moment with the war in Iran and what that's doing to oil prices, and what will the impact of higher oil prices have on companies all over the world, maybe there are better opportunities elsewhere for people to invest, or maybe they simply want to take some profits out of the market. On the flip side, we might see greed and speculation. Maybe people have made some money, so they want to take that money out. Maybe there's positive company news. Maybe there's positive economic news. Maybe there's this fear of missing out. Everyone is piling in. They see people making money and they want to make money too. Or maybe they're investing in a company that they really believe in. These are just some of the reasons that can actually drive share price in the short term. And I've said there that short-term fear, greed, and emotion drives price movements. And this can make for a very bumpy ride in the short term. And there's this lovely cartoon here that says, in the short term, the share market can be a little bit like a voting machine. Simply, we've got over here, social media, comments, news, etc. going in, and this is what drives short-term action. But over the long term, it's the profitability of the company. Is the company making more profits? Are they making wise decisions with those profits? Are they selling more and more products or services? If they are, long term, that will increase the value of that share price. But in the short term, it can be a bit bumpy. So the question then is, if shares are a good place to invest, how do I reduce the risk? So there are 5 things that we can do to reduce risk when it comes to investing in shares. I'm just going to quickly go through them all now and then go through each of them in far more detail. Firstly, we need to invest with a long-term mindset. Secondly, we need to invest in quality. Third, diversification is really important. 4, we only invest money that we can afford to lose, because this is very important from a mindset perspective. And then 5, we want to invest small amounts regularly. So they're the 5 things that we're going to cover now. But before we do, if this video has been helpful so far, can I please encourage you to click the like button, because that helps this content, my channel, to reach more families. And please subscribe, because every week I release more practical, no fluff money videos to help you and your family thrive financially. So please click the like and subscribe. Okay, so let's look at strategy number 1, and that is to invest with a long-term mindset. And by long-term, we typically mean somewhere between 7 and 10 years or longer, because in the short term, we can see that emotion can drive prices down, but over the long term, share prices go up. And this chart is a really good example of this. This is the Australian share market over the past 125 years. So you can see this is a logarithmic scale on the side here. So it goes from 4 to 8 to 16 to 32. If we didn't have it on a logarithmic scale, it wouldn't fit on the screen. So a logarithmic scale, you can see that the trend overall is very, very definitely up. But along the way, we have had periods of time where the market hasn't performed as well. So World War I, it went down by 22%. The Great Depression, 1929, it went down by 46%. The Korean War and the boom bust of the wool cycle, it went down by 34%. If we look at stagflation during the 60s and 70s, we can see the share market went down by 59%. We can see the 1987 share market crash down by 50%. We can see here the global financial crisis, it dropped by 55%. COVID down by 37%. So you can see there have been regular periods of time where for 2, 3, 4 years at a time, the share market has gone down and stayed down for quite a while. So this is why we need to think long term, because in any 1, 2, even 5-year period, the share market could actually be down in value. But when we start to think longer than that, the chances of our investments being down in value decreases significantly. And the second strategy that we can use to reduce the risk of investing in shares is to invest in quality companies. And by quality companies, we mean companies that make real money, qualities that are making consistent profits, growing profits, companies that make or sell things that people actually want, invest in companies that are well known and have a strong track record, and often invest in companies that you use on a day-to-day basis. Good examples of this would be supermarkets, banks, healthcare companies, insurances, utility providers, or even telecommunications companies. Here is a whole range of companies that would fit this bill in Australia. Now, I will say these aren't recommendations, these are just examples. So there are plenty of high quality companies with strong track records that are making profits that we all know and love and use on a day-to-day basis. Strategy number 3 is simply diversification. Don't just pick 1 share, don't just pick 2 shares, don't just pick 3 shares. Have a portfolio of shares. Be diversified in terms of how you invest, and that will reduce the risk. I love this chart from Vanguard because what it shows is from 2013 through to 2024, which asset class, which type of investment did the best in that year and which did the worst in that year. And you can see that the purple here, or the maroon, is international shares. It did best in 2013. You got a 32% return. In 2014, 2015, 2016, Australian property was next. 2017, it was emerging markets. 2018, it was fixed interest. So in that year, nothing did terribly well. But you can see that it is all over the place. There is no pattern, there is no rhythm. So trying to pick what is going to be the best performer next year is really a little bit of a mug's game. So the important thing we want to take from this is diversification is going to help us average out the returns over time. And this is where exchange traded funds are so good, because with one product with an exchange traded fund, and just to let you know, my next video we are going to look at, well, what exactly are exchange traded funds? But exchange traded fund is basically where with one product you can invest in a whole basket of shares. So with one investment, you could be invested in Coles and ANZ and ResMed and Origin and CSL and Optus and Commonwealth Bank and so on with just one investment. And you can also have investments that will invest you in the biggest companies in the world. So with one investment, we could have Tesla, Netflix, Nike, McDonald's, JB Hi-Fi, and so on. So this is the beauty of exchange traded funds, is that it allows you to have one product that invests, basically do the diversification for you. And the fourth strategy to reduce the risk is to only invest with money you do not need. This means we need to be thinking long term with any money we put into the share market. Ideally, we're thinking 7 to 10 years. We also need to make sure that our income is consistently greater than our expenses so that we've got more cash flow coming in all the time. We want to make sure that we've got a cash reserve in place. 3 to 6 months worth of your operating expenses or your day-to-day expenses is what we want to have sitting in a cash reserve. This means that should we lose a job, should we get sick and be unable to work, should we need to take time off to care for a loved one, should the car completely die on us and need replacing, we have cash available to do that. We're not forced to dip into our shares unexpectedly. And we want to make sure that our lifestyle costs are comfortably covered so that we're never tempted to dip into our shares at a point in time where the share price is down and in the doldrums and we're going to have to take a loss. And the last strategy, the fifth strategy, and this is by far my favorite strategy, is simply just to invest small amounts regularly. And I truly believe that this is where beginners should start. This is where you should dip your toe in the water when it comes to investing in shares, is to find an index fund that you're comfortable with and every single month identify an amount of money that you are happy to invest regardless of what the share price is doing. But let me give you 5 really big reasons why this investing regularly, this dollar cost averaging, is so powerful. Firstly, you can start small. You can start with as little as $5 depending on which app you're investing with. Secondly, it eliminates the timing. We're not trying to time the market. If it goes down, great, we're buying more shares. If it goes up, great, we're making more profit. Number 2 is that the market crashes are opportunities. As it goes down, we can buy more shares. Think Boxing Day sales. Number 4, it's easy to automate the process. We can just set up on many platforms these days. You can set up auto invest so the money gets taken out of your bank account, put into your platform, and then invested. And then number 5 is it removes the stress because it just ticks along in the background. You're doing something very, very positive. When the market goes down again, we know that little bits are being put in all the time and taking advantage of those downturns and then benefiting from the upturns. So 5 really big reasons why investing small amounts regularly is so powerful. So let's finish up with a really quick summary. The first thing we looked at is what is risk in relation to investing in the share market. We then looked at the fact that in the short term, share price is driven by emotion. And that can be good emotion or it can be bad emotion, but it's driven by emotion. And this is sometimes why we have this thought process that shares can be risky, that they can be unpredictable and they can be gambling, because in the short term, emotion can be a little bit unpredictable. And that is what drives the markets. But the important thing to note here is that over the long term, share price is driven by the profitability of companies. So that long term, if we've got good, high quality businesses that are making consistent profits and using those profits wisely, the value of those investments will go up over time. We've just got to understand in the short term, it can be bumpy. And then we looked at 5 very simple strategies that we can use to reduce the risk when it comes to investing in shares. So making sure that we have a 7 to 10 year time frame. We need to be thinking long term, making sure that we're investing in high quality investments, making sure that we're diversified. And this is where exchange traded funds can be so helpful. Then we looked at the importance of only investing money that we don't need, investing money that we can afford to put aside for the next 7 to 10 years and that we're not going to need to call on. And then the last one was investing small amounts regularly in a strategy called dollar cost averaging. So hopefully this has made sense. I really genuinely hope that this has given you confidence that investing in shares is not gambling. Yes, it can be a little bit unpredictable in the short term. It can be a little bit uncertain in the short term, but have confidence that long term, the value will follow the profitability of a company. And this is why thinking long term is so important. So I hope that this has got you excited about investing in shares. As I discussed before, if you would like a copy of my beginner's guide to getting started investing cheat sheet, check out the link in the description below. And please remember, it is the little habits and strategies that you put in place today that can literally make $1 million difference to your future.